What taxes apply to UK property investment? Watch today's video to find out more. Hi guys, welcome back to my YouTube channel. This week we're talking all about what taxes apply to UK property investment, running through income tax, stamp duty, capital gains tax, corporation tax, VAT, all the taxes and how they can apply to property so that you're aware of this and then you don't get caught short. Before we get stuck in, please do make sure you hit that subscribe button because it really helps me in terms of growing the channel and helping more people save tax. So make sure you're hitting that subscribe button and also share this with other people that might find it useful, that want to pay less tax, that are property investors, because it helps everybody. Okay, let's get stuck in. So the first one is income tax. So if you own property in your own name, you'll pay an income tax on that. On your rental profits, less your finance costs as well. So by the time you take that adjustment into calculations in terms of how it's disallowed and you only get a 20% tax credit, there's more on that on the YouTube channel and also on other websites. If you Google Section 24 finance costs, you'll see a whole host about how previously they used to be fully disallowable, whereas now you only get a tax credit. Not a subject to this video, but broadly you'll pay income tax on your rental profits. This is added with all of your other income as well. So if you've got employment income, dividend income, salaries and whatnot, all of this gets taken into account and then taxed. As a basic rate taxpayer, you'll pay tax at 20% on your rental profits, 40% where you're a higher rate taxpayer, and 45% when you're an additional rate taxpayer. Also, for a lot of people that are investing in limited companies now as well, technically you do pay income tax on your property income because when you get in your limited company, if you want to pull it out, you pay income tax on salary, dividends and interest that you actually take from your own limited company. So income tax is very, very difficult to avoid because it's taxed so widely on all different sources of income, but this is how it applies to property investment. As a landlord trading for your own name, especially with regards to income tax, you will need to file a self-assessment tax return. So you do this for each April to April for the tax year, and all income you've received during that period must be disclosed on that tax return. If you're a new landlord and you've not previously filed one, you've got until the 5th of October following the end of the tax year to request this from HMRC and get a unique tax reference, your UTR number, which you'll need to file your self-assessment tax return. So for the 2020-21 tax year, which is recently finished, you've got until the 5th of October this year to request that from HMRC. Any later and you do risk getting a late filing or late notification penalty. So that's it for income tax. Next we've got stamp duty, land tax. This is the big one. This tax applies when you buy a property. So whenever you purchase a property, you will be liable to stamp duty, land tax based on the consideration, so how much you bought the property for. Whether you own properties in your own name or for a limited company has an impact on the rate because we've got now the additional dwelling supplement, which broadly means if you already own a home in your own name, you will be paying the 3% extra. For all limited companies, the 3% surcharge also applies to the normal rates, which means rates are typically around 3 to 5% depending on the value of the property that you're purchasing. So in the UK, if you're buying a property in a limited company, it's 3% up to 125 and then 5% after that. The stamp duty is payable 14 days from date of effective completion, so whether you complete on the property or you effectively complete, you get occupation or pay more than 90% of the proceeds, I think it is. That's when your stamp duty is due. Usually your solicitor will handle this for you, but there are many reliefs available for stamp duty, multiple dwellings relief, probate relief. The rates that apply to commercial properties where you buy 6 or more properties in a single transaction, commercial rates may be available. It's a very, very complicated area with tons of relief being available, so always check with a specialist just like can be done with regards to the stamp duty payable on the purchase of the property. Remember that solicitors, they're not stamp duty specialists. Their job is to convey the transaction, do all the paperwork, do searches, exchange title. Their job is not to be an expert at stamp duty. So definitely make sure you're getting some specialist advice on stamp duty, especially where you think there's something can be saved. If you're buying just a single property and it's all just buying a newish property from a normal person, there's no probate involved, there's no falling chain, anything like that, there's usually not something that can be done. But always have a check with ourselves, with your accountant, just to see what can be done because it could be worth thousands of pounds in extra tax that's being saved. So capital gains tax is the next tax. This applies to individuals that are selling property in their own name. So as an individual landlord or trading for a partnership, you'll be liable to CGT when you come to sell the property. So any gain that you've had When you sell the property, you'll less your purchase price, less the stamp duty that you on when you purchase a property, any costs of acquisition such as legal fees, surveyor fees, and then also you deduct your costs when it comes to selling the property, such as your solicitor's fees for selling it, estate agents' fees. And when we take all of that away, you're going to get left with your net gain. If this is under £12,300 for this tax year, happy days, there's no tax to pay. If it's above this, then tax will be due a mixture of 18 and 28%, depending on whether the gain falls into your basic rate band or your higher rate band. With a disposal of residential property, you've actually only got 30 days to file a return to HMRC and pay any tax due. It used to be 31st of January the year after, whereas that's all changed now. For residential property, you've only got 30 days. So make sure you are on top of this, because they are issuing fines for people that are late. So it's definitely worthwhile watching out for this and making a note. Commercial property, slightly different. The rates are lower, 10 and 20%, and then with commercial property, you've actually got until the normal tax return deadline, 31st of January, the year after the tax year has finished, in order to do that return and get that tax paid. It's worthwhile noting that every UK taxpayer has a £12,300 capital gain annual exempt amount. So this is fantastic for doing small disposals, so you can stagger your gains into different tax years and as a result use your capital gain annual exempt amount. And remember, husband and wife, spouse, civil partner, you get that gain each. So if you've got a wife that's doesn't own any of that property, might make sense to add her on, give her a small ownership, so when you come to sell the property, you can use her CGT annual exempt amount. So the next tax is corporation tax. This only applies to limited companies. So if you're a property investor trading for your own name, the main taxes to be aware of are income tax, stamp duty when you purchase the property, and CGT. Whereas people going for a limited company, income tax doesn't directly apply, either does CGT. It's just stamp duty and corporation tax. So corporation tax is what you pay on the rental profits. So any rental income you receive, less of your allowable expenses. Important to note, for a limited company, finance costs are still fully tax deductible, which is absolutely fantastic because it's going to be saving you tax there. Also, when it comes to selling a property, a limited company doesn't actually pay capital gains tax. It pays corporation tax on its capital gains. So it's a lower rate. At the moment, it's just 19%. Compare that to the rates that apply to higher rate taxpayers, 28%. That's a 9% tax saving there on using a limited company compared to owning it through your own name. So with a limited company, you'll need to file a tax return to HMRC and also a full set of accounts. These need to be filed usually the accounts 9 months after the year end. The tax return needs to be filed 12 months, but any corporation tax needs to be paid 9 months after the year end. So as a rule of thumb, it's best to get everything sorted and finalised 9 months from the end of your accounting year for your limited company. It's also worth mentioning how VAT can apply to property as well. Usually for residential property, VAT is not applicable on the purchase. So whenever you purchase property, it's an exempt supply. Only time this is different is when you're buying a new build property, in which it might be 0 rated, but as a property investor, that doesn't make too much of a difference unless you're actually the developer yourself selling the property. But one thing to watch out for is where you're doing a lot of conversion works or refurbishing a property, whether the 5% reduced rate of VAT can apply on those conversion costs or those development costs rather than the 20% standard rate. But for most buy-to-let property investors, because rent is an exempt supply, there's no VAT you can charge on it. It doesn't count for VAT registration threshold. So whether you've got £85,000 or £1 million worth of rental income from residential property, you cannot register for VAT. And as a result of this, you cannot reclaim VAT on any input costs you have, such as accountancy fees, letting agent fees, and the like. So that's definitely something to bear in mind as a property investor. But they're really the 5 main taxes that apply to property investors. Of course, there are a few smaller ones here and there, but as a broad summary, that's how they apply to UK property investors. So I really hope you've enjoyed today's YouTube video. Please do give it a thumbs up because it really helps YouTube push this video and this tax saving content to more people so they can benefit from it. And of course, make sure you subscribe at Joshua Tharby and share this video with anybody else, new property investors that may benefit from this tax saving content. Cheers for watching, guys. Have a great day.